Welcome to Market Call. I'm Morella Fernandez. Chris Blumas on the show with us today. He's portfolio manager at Raymond James Investment Counsel. He'll take your questions on North American large caps. Here's how to reach us. Call us toll free, 1-855-326-6266. You can also email your questions, marketcall@bnnbloomberg.ca. Chris, thanks for coming in. Good to see you.
You too. Thanks for having me.
What do you think first of the American numbers for inflation? We saw a steadier trend for headline inflation, but core inflation's up.
Yeah, core inflation's up. I think overall, I think this was quite positive this morning. I think that's why you saw equity markets, bouncing a little bit. It is in terms of the time frame for the tariffs to impact core inflation, it was supposed to kind of start to trickle in with this July number. And what you saw with that is you haven't really seen, I think, it was up just very, very slightly from June. So I think overall it was positive, but it's still a kind of a wait and see. I don't think it was as telling as some people might think, but it was a positive nonetheless.
Okay, why do you think we haven't seen the spike that some anticipated?
Well, this is where it gets difficult to estimate. But if you look at, there's been different investment banks that have put out different research pieces on kind of the absorption of the tariffs. And the initial implication is that about somewhere between a third to 2/3 is likely being absorbed by companies instead of being passed on to consumers, either through, advanced inventory buildups and things like that. As time passes, that will,
they'll stop absorbing it.
They will,
yeah.
and they'll have to pass it on to consumers. And what you see even with credit card delinquencies, mortgage delinquency, you're seeing consumers, North America, starting to become more strained. So then the ability to pass that on is tough, And I think when consumers only have a certain amount of discretionary income and prices are up, then they have to make some decisions in terms of allocating their capital. So I think overall it was positive, but I think it's still a shorter term data point. I think we still have to watch. I think the estimates is somewhere over the next up to 12 months, before we see the full impact of tariffs on U.S. prices.
Yeah, the argument I've heard is that some of the retailers don't want to start passing on the cost until they know what the tariff rate has been settled at, right? There's been so much back and forth, especially with China. And so until they know what they're dealing with, they don't want to start passing that on to the consumer. Does that sound like a valid reason we're not seeing prices go up the way we had believed?
Absolutely. And I think, companies don't want to pass it on, but then even to some companies, especially even on the retail side, being able to stockpile some inventory, they actually, their inventory is at a lower cost point than it would be, say, from this day going forward. So, their working capital commitments had gone up, but then they're able to kind of keep those prices low for consumers. But at some point that stops. Okay,
so let's talk about the Federal Reserve as well. A lot of pressure, political pressure on the Federal Reserve to cut the rate in September or before. Two things. A, does this lean you more towards a rate cut in September? And B, Trump wants a rate cut now, is what he's saying. Has the Fed ever sort of cut, like in between announcements, like made a paper announcement that it's going to cut a rate?
No, what the Fed tends to do between announcements is through what they kind of call their forward guidance, basically their language. When they're at these public press conferences or different Fed governors are talking, they'll kind of guide anyone listening, and that's how they kind of do it. It's a softer way than actually having a rate announcement. I can't remember seeing a rate announcement like an emergency type one. The only time I can remember that was in the financial crisis 08-09. So I don't think you could expect to see something like that, just given that we are fairly stable. But there's definitely a massive amount of pressure to cut rates, and then with today's lower inflation, that increases the odds of a rate cut if inflation can stay in check.
Got it. Okay, we're going to take a quick break. We're going to line up some phone calls for Chris Blumas, Raymond James Investment Counsel. He's taking your questions today on North American large caps. Here's how to reach us. We're back in a moment. Welcome back. We are going to start with an email from Stu. He says, would Banco Santander be a good long-term hold? Do you follow Banco Santander?
I do follow it kind of superficially. I think this is, like as you see in the chart, like the banks have had a really strong run. And I think in terms of my focus and kind of where my preference for allocating for clients, I tend to go, as Canadians, there are good things we can get in Canada. Income stocks are really, really good for Canadians. We have, really high dividend yields, and the banks are right in that wheelhouse. And so I think, when I look outside and I look at some of the European banks and some of the US banks, you want to get a sense of what they're doing. But I think, if you looked even in Canada at something like a Bank of Nova Scotia, very, very undervalued, very, very high dividend yield, you do have some emerging market exposure. And I think that's one to me that I find just a little bit more interesting because, you own a foreign bank. So, a lot of people want to own a foreign bank to get the dividends. But, when you own a foreign bank, you're going to get some withholding tax on your dividends. So that rate comes down, say roughly about 15%, depending on the jurisdiction. And the payouts tend to not be as high as a Canadian bank. So you look at something like a Bank of Nova Scotia, the dividend yield's right around 6%. You've got a single-digit price multiple. You've got, some positive momentum in the business. And so I think, you're going to get paid to wait. And there's a little bit of an opportunity for multiple expansion. So I think that would be more of my preference versus something like a Banco Santander. And I just don't think, in the foreign markets, you're really, especially in this case with the valuation, you're really not rewarded for going out there. So if you're not going to be rewarded for going out there, why bother? Do the banks outside of Canada or outside of North America tend to have higher dividend payouts? Is that why people tend to be sort of lured by them? No, it might be a bit of the opposite because their payouts would be lower. But then it's the growth. Like the banks, like the big banks, like a Banco Santander, JP Morgan, they tend to be, a little bit less geographically constrained than, say, a Canadian bank. So the growth profile is better. And so that's what lures people. When, you look at Canadian bank growth, it's kind of somewhat tied to Canadian GDP, where, the international banks, it's less so. Got it. Okay, let's go to the phone lines. Ken's on the line. He's calling from Markham, Ontario today. Hi, Ken.
Oh, hi. Thank you for this opportunity. Good afternoon for both of you. Chris, my question is on BYD, Boys Service Group. Yeah. What's happening with that? I mean, last couple of months, it is ways down and is going sideways. I'm holding it for a long time, and I was thinking whether to stay in or side to get out. Okay, your opinion will be appreciated.
Thank you for the question. So they do collision services, repairs, that kind of thing. Would they be affected by the tariffs, which, of course, vehicles going back and forth, parts going back and forth across the border? Would that sort of push them down, depress them? Yeah, so this one is kind of being negatively impacted by a variety of things. So even pre-tariffs, it really was labor with them. So like you mentioned, they do collision repair. They tend to be, acquisition oriented. And it's just, as minimum wage and rates have gone up, their employment costs have gone up, and they haven't been able to find enough, trained staff. So they developed their own program to train staff, but there's a little bit of a lag. So that was what was happening kind of pre-tariffs. And then after tariffs, a lot of the parts that they use, could be subject to tariffs. And so I think, what you're seeing is with some uncertainty, consumers for non-essential repairs are kind of sitting on their hands. And then when you have to do repairs, they're getting just a little bit squeezed because their costs have gone up. So that's why you've seen it kind of trending sideways. If you look at a longer term chart, this has been a company that has created quite a lot of value for shareholders. And really, it has been through the acquisitions. They've been they're essentially a U.S. company, right? Like they do a lot of collision repairs acquisitions in the U.S. And so, they're unique in that space because a lot of their competitors are other private equity firms versus public companies. So it is an attractive kind of defensive type business, but the valuation is a little bit rich. So, I mean, if you do own this one, I would just sit tight. And if you're looking to get into this one, I would just wait for a little bit of a pullback. It is a very, very cash flow positive business. It's just, I think it's a little bit rich right now. Yeah, so it was at 244 sort of end of February, and then started trending down to now at 191 or 190 or so. Okay, let's move on to another caller. We have Chris, who's on the line from Victoria with a question. Hi, Chris.
Hi, Marella. Hi, Chris. Thank you so much for taking my call. Chris, I'm hoping to get your opinion on CN Rail. It's been a long-term stellar performer, except in the last few years, it's definitely come down. And I'm wondering if you see if the long-term prospects for this company are still intact with the new rail possible mergers going on, Union Pacific, Norfolk Southern. There seems to be a shakeup potentially happening, and I'd appreciate your thoughts.
Okay, a couple of things to extract from that. Transportation has had a harder time so far this year. There is sort of bubbling up a possible deal in the U.S. First of all, do you think that deal he mentioned will go ahead?
This is tough. Like, I don't know how to handicap it. I would say, given, the current administration and their kind of pro-business stance, it's probably more likely than it was under a prior administration. So I don't know, can I say, is it 50-50? I don't know exactly. But to me, from when I'm looking at it, the odds definitely go up with the current administration. So I wouldn't be surprised to see it go through, especially if the case was that consumers and shippers will benefit.
That being said, it wouldn't provide competition necessarily for CN, would it? It would provide more competition for CP?
Well, the potential merger in the U.S. is more U.S.-centric, right? And it essentially what would do is would kind of tie the East Coast and West Coast together to make things a little more continuous. It's going to be more competition for everyone. But, that's probably likely going to be a positive because, with the precision railroading kind of operating framework that a lot of these companies are doing now in terms of kind of cost cutting and kind of performance pricing, they've all tried to become as efficient as they can. And that's really what's driven, for many years, that's what drove CN. And then, as the management team changed and moved over to CP, that kind of way of operating has kind of permeated the industry now. So I think it is a very, very attractive industry from a concentration perspective, right? There's only so many players in this industry. The negative part is there's probably not as much growth because you can't grow outside of the North American market. And they are economically sensitive. So that's why, the rails, being economically sensitive sold off pretty significantly with Trump and the tariffs. I think longer term, they're impossible to displace, right? So I think, for people that own it, I think it makes a lot of sense to sit tight. In terms of my preference in the space, like I'm a huge fan of CP and that, kind of unified footprint kind of across Canada, US, and Mexico. I think longer term that will pay huge dividends. Over the short term, it's likely going to take a little bit of time for that to come back into favor. But between the two, that's my preference. But if you own CN, I don't see, if you own it, like I would just sit tight. The valuation's very, very reasonable. It's about 17 times earnings. Yep. So it hasn't been down there for quite a while. So I think it's when you just be patient and you sit tight. Got it.
All right, Chris, we're going to take some more questions and emails. We'll take a break as we get to those. We're back in a moment. Chris is taking questions today on North American large cap stocks. We're back in a moment. Welcome back. Thanks for joining us on Market Call. Let's go to Dave. He's holding on the line in St. Catharines, Ontario, with his question. Hi, Dave.
Hi, Marilla. Thank you for taking my call. Chris, I'd like to ask you about Royal Bank, and it's been doing wonderful lately, and I'm just wondering, is it going to continue, and where do you see it in the next year or so? Thank you very much. Take care. Bye-bye.
Thank you. So Royal Bank at 185.52, so up today $1.65, or almost 8%. And 51% over the last 3 years. Yeah. Is there room for this company, which is already a leading company, to go higher?
That's a great question. I think there is. And if you look at how it would happen, Royal Bank, very, very similar to JP Morgan in the US. It's the largest bank in each region, and they're trading at a premium to peers. And so, this has been partly is very justified in Royal's case because as they've expanded into wealth management, they've expanded into very, very lucrative areas. And, some of the problems that have bogged down other banks on the retail side outside of their core jurisdiction, Royal Bank went through that like 20 years ago when they exited retail banking in the US and they decided to go kind of on a more wealth management, investment banking type of road. And I think in this current environment, they've been very, very rewarded for that. And so I don't think the multiple where it's at now, it's somewhere between 13 and 14 times forward earnings. That's typically rich for a bank. That's slightly richer than its history over the last 5 years. But I think it is justified. And I think how you would make money in this stock is through earnings growth. I think if you pay a premium multiple, they're a premium operator, it's justified. But then really how you get a return is from the growth in earnings. And depending on if is it high single digits, I don't know what it is. But that's what I think you can kind of expect. And I think that's why my preference has, in some client portfolios, I do own Royal Bank. I haven't been adding it for clients just because of valuation concerns. And I've been, what I spoke a little bit about earlier on the Bank of Nova Scotia, I've been leaning a little bit more towards the beaten up ones, the Bank of Nova Scotia and the TD for me, where you could get, a below market multiple, an okay amount of earnings growth, and you're going to get paid to wait. I was more kind of favorable towards those, but it's nothing against Royal. I think if you got it, you sit tight and you let it keep working because it's been a phenomenal investment. If you're looking for a little bit more value, I think you look towards one of the other two.
Got it. Okay, let's go back to the phone lines. Faisal is on the line from Toronto with this question. Hi, Faisal.
Hi, Mirella, Chris. Thank you for taking my call. Chris, always look forward to having you on the show, my friend. You're one of the sharpest minds in the business. My question is on Tricura. It had some restructuring, and I think they've gone past that, and the earnings came out. Would this be something you'd be buying at this point? And Mirella, just before I jump off, there's some really incredibly smart people who call on the show. John, Anita, Elliot. Idea for your producers, maybe you hold a program and have a round table with these folks. Just a suggestion. I'll hang up and listen. Thank you, guys.
Okay, thank you for the question. Let's talk about Tricura, which is an insurance company. How much do you know about it?
Well, so this is one, this is a, many years ago, this was kind of a spin out from a Brookfield entity, right? So
okay.
This is a different branded, it wasn't branded Brookfield, but it was Brookfield executives who kind of, once it was spun out. The thing with this one is I always find, like my background was earlier in my career, in financial services and in analyzing these companies. Insurance is remarkably hard to analyze. And I don't own this one. I have watched it. It has done very, very well since its spin-off. The thing is, in my client portfolios, it tend to be fairly focused, somewhere around 25 individual securities. It hasn't been one that I've gone to. I think when you look at kind of the insurers, even in Canada, the P&C insurers and Tricura, Fairfax, very, very good operator. Intact, very, very good operator. Tricura started, they've come out of the gates doing very, very well. For me, and I think for any investor, it's a kind of your comfort level with really what those earnings numbers are. And any insurance company can generate earnings. And if they revise their reserves down the road, it wipes out any earnings they've accumulated and any retained capital in that business. And so, this is one, I think you have to have very, very aligned interests. And so I think my go-to names would be on the insurance side. The two that I've used in the past have been Berkshire Hathaway and have been Fairfax in Canada. And I think, in terms of valuations, both of those are very rich. You look at Intact, valuations very rich. This space to me right now is more expensive because it tends to be counter-cyclical. So as money has kind of flowed into it, because they're less economically sensitive, the valuations have been bid up. So I think this is an area I don't own right now, and I would just steer clear of temporarily.
Got it. Okay, let's move on to Bob, who's calling from Toronto with a question. Hi, Bob.
Hi, Mirella. Thanks for taking my call. I'm wondering if you guys can tell me about Emera. I've done fairly well on it, and I'm just wondering if it's sort of reached its heights and I should be selling it now. Thanks a lot.
Okay, thank you for the question. We'll pull up Emera right now. They do electrical, natural gas generation, and transmission. What do you think of this company?
So this is a regulated utility, right? So it's a very stable, dependable business. Emera has a big footprint in the U.S. as well. So was weak for a period of time. If you see just according to your chart, it was down big. And that was really had to do with kind of the regulated footprint in the US, but then also the balance sheet. So I guess to answer your caller's question right off the bat, I think this one has more to run. I think, they have a very good footprint in terms of their jurisdictions that should allow for some growth. The balance sheet is significantly improved. And the valuation is kind of below peers. So, I think this one has more re-rating to occur. So I would just sit tight on this one. And if it's something that you're worried about, even if we say in a very negative economic scenario, interest rates get cut, these type of regulated utilities in a lower interest rate environment, it tends to bid up the valuation even more. So I think this is one that does have some valuation support in the current macro environment, and that it also has some positive things working for it, company specific. So definitely don't exit this one yet. Just sit tight and let it play out. If you're really worried, just use a stop loss to just lock in your gains.
Got it. Okay, we are going to take a quick break, but when we come back, we'll have a look at Chris's past picks. We're back in a moment. Time now to go through past picks with Chris. His first one is Brookfield Core, and this is from August 14th of last year, so almost a full year ago. Recommended at $63.53 up to $90.28, so 42% upside and a 43% upside for total return. This is essentially an asset management company. What have they been doing right, obviously, with this number of 42% in gains?
I think they've been doing a couple things right. I think one is the underlying business, right? The underlying business on top of their kind of corporate investments is private equity, right? And if you look at allocations towards private equity institutionally, and then even now with potential changes to the 401k plans in the US, there's going to be more demand for private equity. And I think so the very large players, the Brookfields, the Blackstones, the KKRs, are very, very well positioned from a product, from a geographical perspective. So I think one is the underlying business has some really strong tailwinds. And I think, if you kind of look kind of a year ago, just valuation was very inexpensive. So what you've had here is some really strong earnings growth and some multiple expansion for creating that bigger return.
So obviously you'd hang on to this.
Absolutely. This is a core name in client portfolios. I tend to focus on compounders. This is one of the best compounders there is out there. It's not one that I would buy. It's a little bit above my buy price right now. So, which you're probably going to hear a lot today is just, wait for a little bit of volatility. We're in an environment now where there could be lots of headline volatility. And if you know what you want to get, there will be some opportunities to get things at lower prices.
Got it. Okay, let's get to your next pick from last August. Abbott Labs on the New York Stock Exchange, at the time $109.89 US, now at $130.84 US, or return 19% up and a total return 21% up. They do healthcare products and services. Big market cap here. Is this a company you like moving forward? They're out of the States, right?
They are, but they are global. And I think this is it is a medical device company. And if you look at kind of, healthcare in the US, pharma is a little bit in the penalty box just because of pricing, and there's going to be some pressure. So far devices haven't come under that same pressure. And so if, what Abbott was a massive beneficiary for some of their testing equipment during COVID. So their financials look a little bit weird because you're seeing, some part growth decelerate, but that's because it was such a massive boom in demand for their testing supplies. But if you look at the underlying organic growth in the core business, it's almost 10%. It's very, very strong. And so I think, there's massive demographic support. There's just so many things that I like about the business. It is diversified, in terms of devices and in terms of cardiac. So valuation-wise, it's right around 20 times earnings. Very, very inexpensive for a company that, has really, really strong growth. And it is, I think for me, if you look at it for Canadians, what are some things you can't get in Canada? And healthcare is a big one. And so you need to look globally to get your healthcare exposure in your portfolio. And I think this is one that's really, really strong. So it is one I like, still own it today. But again, it's a hold. It's just slightly above my buy price. So it's one for somebody looking to enter, just wait for a little bit of price.
Pull back here.
Yeah.
Got it. Let's get to your third pick from August of last year, Great West Life Co. at 42.41, now up to 53.38, so 26% upside for return, 31% for total return. How's insurance been doing, generally speaking? We've seen sort of growth in Asia for I guess, Sun Life and Manulife. Yeah. What about Great West?
So I think the only way I can kind of describe Great West relative to its peers, it's, when they zig, they zag. They're totally different. They have a core business in Canada, just like Manulife and Sun Life, but where the other companies have chosen to get kind of Asia exposure, either through China or through India, Great West has done the opposite. They've gone mature market Europe, where they can build scale, get attractive acquisitions. And I think this is one, I always try to have one pick for income-seeking investors. And so to get 30% on an income name, I think that's pretty good. And I think those go to the points where you're looking something that was for a little bit undervalued. It was a single-digit price multiple. It's still a very low multiple. It's around 11 times earnings. But, last year you're getting it for sub 10. And it still has a really, really strong growth profile. And they're very, very good at allocating capital amongst the different markets they're in to build scale. So this is a kind of a core holding for me, has been almost for my entire career. I just like, I like the footprint, I like the value focus, and I like what they've been able to do. So it is one that I still own, but again, like my prior ones, it is a hold. Okay. It's just slightly above my buy price. This one's about 5% above. So, on a little bit of a pullback, I think it's one you want to, if you're looking for income, right? Like there's better growth names out there, but for people looking for some income, this is a great dividend yield. It's probably right around high 4s, low 5s,
okay.
And has some good growth as well.
Got it. Okay, we're going to take a quick break. Chris is sticking around. Take your questions on North American large caps. Back in a moment. Welcome back to Market Call. Let's go to the phone lines. Bill's on the line in Toronto. Hi, Bill.
Hi there. Thank you for taking my call. My question is on Pembina Pipelines. Over the past month, it's been a top pick by many guest hosts, but it seems to be doing nothing when it comes to any kind of movement. It's been trading near the 52-week low for the last, it's bouncing off for the last couple of months. Is this one you just buy right now, tuck it away, collect the dividend yield, and we'll go from there? Thanks very much, and I'll hang up and listen to your answer.
Okay, so what do you think of Pembina moving forward? Are they going to benefit from the natural gas lines that are now going to get sort of gas to international markets?
Yeah, they are. I mean, this is one, I guess to answer the viewer's question right off the bat, this is probably, I think this has been kind of the worst performing kind of infrastructure or pipeline name over the short term, just because they're having some issues with an asset in Canada in terms of the regulated pricing has been kind of set lower. So there's an overhang on a couple of the assets, and that's really what's kind of holding the stock back. I think a lot of people have been recommending it. In the end, it would be kind of more on the value side. You know, it's a very well-run business. It has a really good collection of assets. The thing is, if you kind of compare what they're doing to what Enbridge is doing to what, you know, TransCanada is doing, they're all pursuing slightly different strategies now, right? And so Pembina's is pipelines and infrastructure. You know, that infrastructure, the assets are quite good and they're quite strong from a cash flow perspective, but they don't have the same, they're not as bulletproof as say a pipeline. So there is some volatility there. And so I think in terms of Pembina, this is one that I have owned in the past. the main reason why people own it is just because of its growth, because it has pipeline and the midstream, Canada and the U.S. It has it has more outlets for growth. If you look at what Enbridge can do, they're already so big. There's less outlets for growth. I think in terms of my preference in the space, I'm a huge fan of Enbridge. I think the valuation's a little bit rich right now. Do own it in client portfolios. Don't own Pembina. There's nothing wrong with it. I think, from your viewer's thesis, in terms of recognizing some value, buying it for the income and stocking it away, I think that makes a lot of sense.
So you just have to be patient with Pembina?
I think you do.
Yeah.
And I think you're not out there, one positive thing, you're not taking a lot of valuation risk. The valuation is quite low, but it will always trade at a slight discount to some of the other peers just because it has less percentage of its cash flow is regulated.
Okay.
Right. So it always deserves a multiple or a multiple and a half point discount just because it's not all regulated. But it's very well run. They have multiple avenues for growth. So I think, of the Canadian pipelines, they probably have one of the best growth profiles. So you're getting a good growth profile with a kind of slightly discounted valuation. But there could be some headline risk for the next few quarters. But overall, it's quite well run. So I think
hold on to it.
I think so.
Okay.
Yeah.
Let's go to Anita. She's on the line in Markham, Ontario. Hi, Anita.
Good afternoon. Thank you so much for taking my call. My question is on Couche-Tard. I own this company. I did quite well for a while, but of late it's been dropping steadily. I need your opinion on that. I know it has a lot to do with 7-Eleven, so I need your opinion on this. Should I hang on to it, or should I sell it and go elsewhere? If so, would you recommend some other company?
Okay, thank you for the question. Couche-Tard currently at 69.34, a little down today, not much, but as you can see, sliding over the start of the year to now. They were trying to buy some 7-Eleven from the Japanese owners, and a lot of people didn't like the idea that they were trying for that. They thought they were biting off too much at the time. Now they've dropped that, and people still aren't liking the stock. So what is going on with Couche-Tard?
Well, I mean, that was an awesome summary you just gave. I think, it's a massive positive that they're not doing the 7-Eleven deal, I think, from the market's perspective, because I don't think people could understand how they could do it without issuing equity. It was just too big of a bite without issuing equity, and they said they weren't going to issue equity, so how would they do it? So I think the math was awkward. I kind of give them the benefit of the doubt. These guys are first class acquisition. So, if they were going to figure out a way to do it, this is one that I own. I still own it today. I think valuation is very, very attractive. I think the second overhang now on the stock is just the economic uncertainty. You went from the acquisition uncertainty to now the economic uncertainty, because if consumers are going to get pinched, there's a little bit, they're a higher price point than say some of the other operators. But this is a very, very well-run, exceptionally well-run business. It's a phenomenal compounder. It's a very, very attractive price. So I think this is one, definitely don't sell it and go elsewhere. I would just sit tight. And if you have some capital, I think this is one you would want to add to as well.
Got it. Okay, let's go back to the phone lines. Nazar's on the line from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Mirella. Hi, Chris. May I have your thoughts on Nutrien, please? Its second quarter results were positive. The demand for potash looks good, and yet the stock price has retreated from around $82 to now $77. Your thoughts, please. Thanks for taking my call.
Okay, thank you for the question. Is there an overhang on Nutrien?
I don't think so. If you look at the valuation of Nutrien, I think it's fairly valued. I get the frustration from your caller's perspective. I think if you maybe take a slight step back and look at it over the last 2 or 3 years, this has been a phenomenal return. And that's really because of what's going on geopolitically. You've seen potash supplies coming out of Russia or other countries that are quite near Russia have been strained. And so what that did is led to an upward spike in prices. And there's always these arguments on the potash in terms of the pricing that in the end, people, if the price gets too high, people just sit on their hands. They don't apply it. I don't know what the lasting life is in the soil, but from the farming side of it, if the price gets too high, they don't do it. They delay an application. So it is a very, very important fertilizer, but it is very, very price sensitive and discretionary, and the farmers behave just like you would expect business owners to. If their input costs get too high, they don't do it. When input prices are reasonable, they do it. And I think another positive that was, I do like the business a lot. The one thing that always gave me pause was just BHP and Janssen. They've stated that they're coming in. They've announced now that they're delayed and it's been pushed out. But they're committing billions and billions of dollars to build out, the Janssen mine, which is, BHP and all their other commodities only produces one way. They flat out produce, and they crush the price.
Yeah.
And so that's enough for me to just say, I don't want to be there.
Okay.
And so I think valuation is quite fair on this one. It's had a really good run over the last 12 or so months. And so this is one that I would look to exit. So, I don't think the shorter term weakness, it's been weak shorter term, but the price has had a massive, massive run, and the valuation is quite reasonable.
Got it. Okay, we're going to take a quick break. We're lining up more phone calls for Chris Blumas in a moment. Stay tuned. Welcome back. We want to go to Jacob, who's in Toronto, with a question. Hi, Jacob.
Hello, good afternoon. I'd just like to ask your guest about the Shopify, please. If there's any hope to buy it right now or later when it goes down a little bit. Thank you very much and have a nice afternoon.
Okay, thank you for the question. So it's at 204, up $1.23 just today. This is on the Toronto Stock Exchange, of course. It's done very well with its recent report, something like 31% up for revenue. This company is going to obviously continue to grow. Would you expect there to be a bit of a pullback at some point where we can enter?
I do. This is one, I would say, this is a type of company that this is a little bit out of my wheelhouse. I tend to focus on cash flow. And, this is a company that's been growing, like gangbusters. But if you look at it on a free cash flow basis, to me, it's just too expensive, right? It's a very well-run business, but for a software type business, it just doesn't have the margin profile of some of the other companies that I've invested in. And so I think this is one that I watch just because it's so significant. And you alluded to it, their most recent quarter, I think the stock might have been up 20% on the day. And really what you saw in that is that, the changes on taxation coming out of the U.S. hadn't really impacted Shopify. More people, they're doing more business, more people are coming on the platform. And, that de minimis $800 taxation amount was thought to kind of really, really impair Shopify because there's a lot of
smaller vendors on there
doing that. And their results just tore that whole thesis to shreds. No, people are coming on, they're doing business, their merchandise volume was amazing. So it's a business that it just keeps doing exceptionally well. The flip side is I just put this one in the momentum bucket. This is one, it did really well. The price has gone up. People are going to chase it and keep bidding it up. But at some point, growth could slow. There gets to be more of a focus on cash flow and fundamentals. The free cash flow yield is less than 1%. So to me, there's just not enough. It's great the company's growing and doing exceptionally well. There's not enough cash there for me to get me interested. And so I think, alluding to your caller's point, I think the valuation is really rich. It's just something that you really, really want. I would just wait for a pullback because you always get it.
Got it. All right, let's go to Robert on the line from Scarborough with his question. Hi, Robert.
Oh, hi. Thanks for taking my call. My question is on Thompson Reuters, TRI.
Yeah.
It's been described as a quiet performer with double-digit returns over 1, 3, 5 years. It's been added to the NASDAQ. I'm just interested in knowing, would you buy this company now? And when would you get in if you would buy it?
Okay, so Thompson did report recently, essentially a media company. What's your take on it?
To be perfectly honest, this is one I wish I bought years ago. I had owned it earlier on in my career. It was it was a little bit lethargic, and then a new management team came on board about 5 years ago. They kind of just pruned the business and it did such an exceptionally good job doing that really unlocked a lot of organic growth and got them really focused on some really key markets. So I think it's a wonderful business. This is one I would love to own in client portfolios. I think it's just a bit rich for me. So this is one that I'm kind of watching and waiting. So I would kind of advise your caller just to do the same. I wouldn't chase the valuation here. The valuation, this is one, it's north of 30 times earnings. It has a really good cash flow profile, is growing exceptionally well, and they are finding ways to integrate AI into their different platforms. So I think it is very well positioned for the future. They really target tax professionals, accounting, law, so service professionals who need their product to perform their service. So I'm quite constructive on this one. It's a valuation issue for me.
Got it. Okay, we do have to leave the phone calls and the emails there. When we come back, Chris will share his new top picks. Back in a moment. Join us tomorrow for Market Call. Kim Bolton on the show, President and Portfolio Manager at Black Swan Dexteritas. He'll be taking your questions on technology stocks. Time now to have a look at the new picks from Chris Blumas, who is with us today. His first one is Alphabet, and we were just talking about the fact that Perplexity AI has now made an offer unsolicited to buy Chrome, essentially, from Alphabet, the Google search. And the price point is $34.5 billion is the offer. First of all, what do you think of the offer?
I don't know, because it's really hard. The way Google reports, they don't exactly break out the kind of the revenues and the operating profit by product. And so, really what they do is they kind of group anything kind of search-based within
advertising revenue?
Yeah.
Okay.
And that's like 95% of all revenue. So, the other bets, which in their cloud services business, like the cloud services business just recently started generating positive operating income, but the other ones are negative. So I think, this is one to me, there's just so much underlying value. And, the big risk, I think, is the regulation. But I think in a variety of scenarios, you're covered. If Google is forced to break up parts of the business or sell off parts of the business, they're not all reflected in the valuation. There's a lot of hidden value there. If they're allowed to keep going on with different operating parameters, you'll do quite well. I think this is a company that's quite good on allocating capital. The business generates tons of free cash flow. So, I think when you just look at the valuation and what this business has grown at, to me, it just stands out as just such big value. So I think it's one that I would recommend. I do own this one for client portfolios.
Got it. Okay, let's get to your next pick, which is Brookfield Infrastructure Partners. So you like Brookfield overall, is what I'm reading into this. But what do you like about infrastructure moving forward?
Yeah, so this is how I kind of do it in client portfolios. Usually client portfolios would own both. They own Brookfield as a compounder, and they own Brookfield Infrastructure as an income name. After that, I kind of cap the exposure at that. And I think they provide, for me, two very unique things. Like Brookfield's a great compounder, and Infrastructure Partners, they've got 4 different operating segments. They operate around the globe. This is one that's trading at less than 8 times, cash flow, great dividend, a dividend payout ratio that's well supported. It's about 50% of cash flow that they're paying out. And I just think, it gets a little bit of a discounted multiple because it's controlled by Brookfield. But I think for anybody looking for income, it's a great way to get income, and you'll likely get some good growth and a multiple re-rating at some point. So I think from a total return perspective, it's one of the highest I have in the total return expectation for an income name. So it's one I really do like. Okay.
Your last pick is Main Street, and they have sort of apartment buildings. I'm wondering generally what you think about the real estate sort of ownership in general, that space right now, and why you chose Main Street equity in this space.
Yeah, this is the only kind of real estate name that I own in client portfolios.
Recently owned?
Yeah, I own it today, would buy it today. I think it's just, again, this is an exceptional compounder. It's not a REIT, it's a corp, so they retain the cash flow they do. They compete in a very unique space where there's just not a lot of competition from larger operators. And so, they fill a very, very unique void, and growth has been tremendous. So I think this is one, in terms of valuation, it's right around 17 times funds from operations. I think a very, very reasonable multiple for a business that, is designed to operate counter-cyclically. And there's massive fundamental demand for housing. But as interest rates come down, housing affordability becomes strained. It pushes more people into apartments. This is right into their playbook. And they've always operated counter-cyclically. Because they're not a REIT and they don't pay out the cash, they always have access to capital through debt, through CMHC, and then also internally to go out and do acquisitions in bad times in the market. And I think this is, one in terms of a real estate performer. It's got to be the number one real estate performer, in the history of the Canadian markets. And part of it's structural because they're a corp versus a REIT, and because they do that counter-cyclical strategy.
Okay, so Main Street Equity on your list of 3. We will have you back and check those, I'm sure, in a couple of months' time. Chris, thanks for joining us today. Appreciate it.
Thanks for having me.
That is it for Market Call today. Thanks for watching. We'll see you again tomorrow.